Hello everyone, welcome to JD's guidance once again. Friends, we are talking about efficient frontier, and in the part 1 of the video on efficient frontier, we have actually seen the concept of efficient frontier. In a very nutshell, efficient frontier represents all those combinations which are the best in terms of their risk and returns. Each of this portfolio provides some kind of returns with some degree of risk which no other portfolio can provide. So that's why they are the best in terms of returns and the risk. Now we will extend our discussion today with a concept, that is the capital market line. Now friends, I would just make the video such that the first part of the video will explain certain more things about the efficient frontier, and the second part will link the efficient frontier with the capital market line. The idea is very simple. So we are having the portfolio returns here, and we are having the portfolio risk measured by the standard deviation or variance, whatever. Now friends, when I have an efficient frontier, we are actually, if you refer to the last video, we are having a frontier which looks like this, where you can see that each point represents some portfolio with distinct returns and risk, and they are considered to be best. Now here I can say this is the maximum point, that is B, which is the most efficient portfolio. Out of all these efficient, B is the most efficient. There are several reasons that we will see later, but just a small reason that I can convince you at this point is that you can see if this is the best, how can I consider this portfolio to be the best of all? Because I can still increase my returns by taking some more risk. Increase the return by taking some more risk, increase the return by some more risk, and I get the maximum return. But beyond this, I am taking risk, but the risk is not rising, rather it is not rising at the same pace. So it is bending down. Okay, fine, leave this. Now listen one thing. Whenever we have a portfolio where there are securities A, B, C, we have seen that my 100 rupees is invested 20% here, 40% here, and 40% here. These are all my risky assets, and all the risky assets provides me a return which is known as the market returns RM. All the risky assets provides me RM, which is the market returns. But is it always necessary that all the investors will invest in risky assets? Some investors may invest some money in the risky assets, whereas some money in something called risk-free assets. I'll have some money in risky assets invested and some money in risk-free assets like government deposits, government securities, right? Which is free from any risk. There is no risk. So I can also have some investments made in risk-free assets. Risk-free assets. So we call, and the return that give us, the risk-free asset give us is RF, risk-free return. Now friends, I will make some combination. See, one thing, if I invest in risky assets, my return will be very high. Whereas if I invest in risk-free assets, return is likely to be lesser than the risky assets. Taking more risk will give me more return, taking less risk will give me less returns. But as an investor, I would like to earn some extra also, but do not want to take more risk also. So what I can do is that I can have some combination, that with some money put in risky assets, some money put in risk-free assets, and that can be one of my portfolio. This can be a portfolio where some money is invested in risky assets and some money is invested in risk-free assets, say 60% in risky, 40% in risk-free assets. So in that case, I can have a portfolio return, that is my return that I get out of a portfolio, that is RC. RC is the combined return of a portfolio. What does this mean? This means I will get some, W means how much money I have invested in market, that means the risky assets. So 60% into what is the market return, say market return is 15%. So I will write 60.60 into market return is 15 plus how much money I have put in risk-free. Then if 60% is risky, 0.6 is in risky assets. So what is my risk-free? That is 1 minus W. times risk-free assets y1 minus w. 1 is my total money. Out of that I take out the amount which is invested in risky assets, that is 0.6. So 1 minus 0.6 is 0.4. So 0.6 has gone to risky assets, 0.4 has come to the risk-free assets, and let's assume that the risk-free assets provide me a return of 7 rupees. So this is my combined return of the portfolio. Why I am doing like this? I am doing like this because if I invest whole money in the market, I will get 15%, but the risk is also high. And if I put all my money in risk-free assets, I will get less returns, but I would like to earn more. So I make a mixture of some risky and some risk-free securities, and ultimately what is my return is the return from a combined portfolio. Okay, so let's see what's the return here, then the market returns. Okay, so friends, this way I will make some combinations, 0.6, 0.4, 0.5, 0.5, 0.4, 0.6. This way I will change the combined portfolio. I will combine the portfolio, and then I will increase my degree of risk, and accordingly see what is happening here. This is this. Suppose my risk-free return is here, RF. Okay. Why it is here? Because see, one thing I want to tell you, if this is the return of the portfolio, what is the standard or what is the risk of the portfolio, combined portfolio? The risk of the combined portfolio will be the standard deviation of the market, okay, W into standard deviation of the market plus W into standard deviation of the risk-free security. But remember friends, there is no risk involved here, so there is no variation, so this is 0. So let's take the portfolio risk here. So how much money we have invested? 0.6, and let's assume that the standard deviation of the market is 8, so the answer will be 4.8. So this is the risk of the combined portfolio. Okay, so now one thing you can see here, that when you are combining the risk-free and market securities, then your return is lesser than the market, because market provides you 50. Since you have used lesser money in market and some money has gone to risk-free, your return is coming down. But your risk is also less, 4.8. But what is the market risk? Market risk is 8. So you are able to reduce your risk also, because you have diversified your portfolio. So friends, only one thing you can notice here, when you have diversified the portfolio by a combination of market securities and risk-free securities, your returns have come down from the market 15, because market is offering you 15. If the entire money is put in market, you will get 15. But of course your risk, which is in the market, is 8, has also come down to 4.8. This is the return of the combined portfolio, and this is the risk of the combined portfolio as measured by the standard deviation of the combined portfolio, which is nothing but the standard deviation of the market. But standard deviation of the risk-free asset is 0, because there is no variation, no deviation, it is risk-free. That's it. Draw our attention here. Now suppose this market gives me a risk-free return of 7. That means I will have 7 here, but there is no risk, so there will be no plotting this side. Only it will give you return, but there is no risk, right? But as I am making some combination, 16 risk market and 40% risk free. So as I take a step this side, I am taking some degree of risk. So as I move this side, means I am earning 7 plus something, because I have taken this much risk. I am earning something plus something because I have taken some risk. So this way I will go on and I will touch the most efficient frontier. So it looks like a straight line. This is a straight line. Let me draw it again. So this is my efficient frontier, this is the efficient portfolio, most efficient portfolio, and as I am earning 7 by investing in risk-free assets, but I am taking some risk, and I increase from 7 and I go up and up and up and up, and I touch here. Okay, so this line to this line shows combination of risky assets and risk-free assets. Okay, some money invested in the market because there will be some degree of risk. Okay, and some money invested in the risk-free assets. This way I will go in a linear style, a linear pattern, and I will reach this frontier. So this line is known as the capital market line because all the investors are actually having this line, this frontier, and they will behave in a similar fashion, and therefore this B, which happens to be the most efficient portfolio, becomes the market portfolio. Okay, and so every investor will combine some amount of risk-free assets, risk-free security with that of the market portfolio, and then this line represents the most efficient frontier, which becomes a straight line. Okay, so what you are doing here, if you are in this line, any point in this line, you are trying to reduce your risk. So you are a risk averser. You want to reduce your risk. Why? Because you don't want to put all your money here or in the risky assets, but you want to invest something in your risk-free securities also. Okay. So what I want to say is that when you are progressing, if this is the efficient frontier and you are progressing this way, means what you are doing is you are trying to increase the risk and correspondingly you are increasing the returns, and this is the efficient frontier. Okay, this is the capital market line, CML, which is a straight line. Okay friends, so remember that from here to here the investor will get some amount of combined returns on the portfolio, and there will be some combined risk. Always below these points, all the points will give you lesser returns than that of the risky asset, that is B. If you invest all money in B, okay, or in any of the risky assets, it will give you lesser returns. It will give you more returns than any combination of this. As I have shown you, 11.8 is less than 15 but more than 7. Also, any portfolio in this line will have less risk as compared to the only investment in the risky assets, that is point B. Okay. So friends, this is the concept of capital market line, and why it has been done, because you want to avoid the risk or you want to reduce the risk. So you are a risk averser, so you will do some combination of risk-free assets and risky assets. If you don't take up any risk-free assets, then you are somewhere in this frontier, because you are taking all risk and return. You are considering all risk return of risky assets. But here you have some risk-free assets also. Now this is one part of the story. Let's come to another part of the story. Okay, before we go to the second part of the story, remember this equation that we got as a straight line can be expressed in the form of an equation. That is, capital market line can be expressed in the form of an equation. So CML equation tells you that the return that you get from a portfolio is equal to, see, you are getting some risk-free return, that is 7 rupees, plus you are getting something extra. What is that extra? Extra is because you have taken risk. Okay, so how much extra you are getting? So of course you will get more than 7 all these points. 7 you are getting plus something extra you are getting. So what is that extra? The market returns minus risk-free returns. If you are here, you are getting 8 rupees. If you are here, 9 rupees. If you are getting here, 10. So that means from here to here you get 1 rupee extra. From here to here you get 2 rupees extra. So there is a premium that you are enjoying. You are getting some extra returns. Okay. And if I divide with the standard deviation of the market, what does this mean? This means that this is the risk. This shows that this is the premium, or you can say reward. Okay, anyways, we'll write here premium. You are enjoying some premium out of the risk you have taken. Because you have taken some risk, you are enjoying some premium. So you can see 1 rupee premium, 2 rupees premium, 3 rupees premium, you are enjoying some premium. And that premium, okay, so that premium you are enjoying, or if I divide with the market risk, this is the per unit of risk. Okay, if what is the per unit risk that you are enjoying out of this portfolio, or sorry, per unit premium that you are enjoying, I mean how much premium per unit of risk, how much premium per unit of risk you are enjoying. For example, if it comes RF plus, I get here 1.6. What does this mean? It means that if your return, that means you are getting 0.6 extra, okay, or suppose I am writing here this is 100 and this is 20. That means for what is the meaning out of it? That means if you are taking, if the market risk is 100 and you are getting 20, means 20 premium out of 100 risk. Okay, so if I simplify 2 premium out of 10 rupees risk, or if I simplify 1 premium out of 5 unit of risk. So this way, if I again simplify 0.2, that means 0.2 is the risk, sorry, premium per unit of risk. So 0.2 means if I take 1 unit of risk, I get 0.2 as a premium. Okay, so that's it. So risk-free premium. So your returns of the portfolio is something risky, risk-free return that you are generating. Plus you are getting some premium, and that premium comes for the risk you have taken. So what is the premium per unit of risk? Okay, say 0.2. That means out of 1 risk you get 0.2 as a premium, and it depends on how much risk your portfolio has taken. So portfolio standard deviation. Okay, so if your portfolio has taken more risk, say 3 unit of risk, you will get more premium. If it is 2 unit of risk, you will get lesser premium than that. Okay, so this is your capital market line. Friends, what is this capital market line? It says that you will get a fixed return plus you will get some premium, that is RM minus RF, which means the premium out of the risk you have taken. That means if it is 0.2, that means out of 1 unit risk you get 0.2 as a premium, and it depends on how much risk you have taken. This is the factor 0.2, and how much risk your portfolio has taken. So this is your capital market line equation. Remember, this is very important. As I said, 0.2. This is also known as reward to risk ratio. Reward to risk ratio. That means how much risk, how much reward. Okay, risk is 1, so how much is reward? 0.2. So now friends, this is also known as the Sharpe ratio. This is also known as the Sharpe ratio. SHARPE, Sharpe ratio. Remember, at this point your Sharpe ratio is maximum. Okay, your Sharpe ratio is maximum at this point because you get the maximum reward for the risk you have taken. Okay, now friends, this is one part of the story. We have started discussing efficient frontier, which represents all the efficient portfolios, but an investor will generally not invest in all risky assets, some in the risk-free assets also. So he will make a combination of risk-free and risky assets, and as he moves this side, he is adding risk in the portfolio. And finally, he is touching this point. So this line is your capital market line, and this can be expressed in this equation. This part represents the reward to risk, and if it is 0.2, it signifies that if you take 1 unit of risk in the market, you get 0.2 as a premium. How much risk you have taken? Which portfolio you are talking about? Multiply with the portfolio risk, you will get what is the capital market line, what is the return of the portfolio, right? Now friends, I would like to tell you the second part of the story. The second part of the story is something extended. What does this mean? This means that, what is the second part? I am just trying to tell you. I'll draw it again and draw your attention to one very interesting fact. Suppose this is my efficient frontier. This is the point B, which is the most efficient portfolio, and you are combining with RF, risk-free security. If I extend this line, in some books you must have seen, it has extended the line this side. What does this mean? This means that this is your portfolio risk and this is your portfolio returns. Now friends, it's possible that you are investing all your money in all risky assets. Okay? Suppose you have 100 rupees or you have 1 rupee, you have invested entirely in risky assets. So W is equal to 1. Okay? If you have W less than 1, means you have put some money in the risky assets and some in the risk-free assets. You have invested in risk-free assets, which gives you some return. Okay? If W is greater than 1, what does this mean? 1 is the total money you have, which you have invested everything in the risky assets. Okay? But you want to diversify your risk and you have not put all your money in risky assets, some money in risk-free assets. Now if W is greater than 1, it means that you have borrowed some money for investment in risky assets. You want to invest in risky assets and for which you have borrowed some money. Okay, this type of portfolio is known as a levered portfolio, and the return of such portfolio is known as return of a levered portfolio. Levered, levered portfolio. What is levered portfolio? A portfolio where the investor borrows in order to invest in the risky assets. I have one, but I have invested 1.2 in market. Forget this part now. We are now talking about this part. Okay. So here there is no risk-free assets. We are talking only about risky assets. Beyond this point, we are talking only about the risky assets. Risky. And what we are talking about is that we are trying to make some combinations. Okay, we'll not say this now. Now, what is the return of a levered portfolio? How much money you have invested in a levered portfolio will give you the returns from the market. Okay. So, suppose I have invested 1.2. That means my W is greater than 1. 1 is my own money and 0.2 I have borrowed. 1.2 means what? 1 is my own money and 0.2 I have borrowed. Okay. And this our market return is 15. Our market return is 15. Now friends, from this I will minus W minus 1 times risk-free return. What does this mean? This means that my W is how much? 1.2. And what is my own money? 1. And what is my risk-free return? 7. What this means? Where from this term came? This term came because I have borrowed money to be invested in the risky assets. So from the risky assets I generate 15 rupees as return and multiply by 1.2 because I put 1.2 of my money here. 1 is my own money, 0.2 is a borrowed money. Okay. Now 1.2 minus 1 represents what? 1.2 is the total money, 1 is my own money. So 0.2, 1.2 minus 1 is 0.2. 0.2 represents my borrowed money and borrowed money into 7. That means whatever money I have borrowed, I have to repay at the rate of 7, that is the risk-free return. This is an assumption. Assumption of the capital market line is that efficient frontier, the assumption of efficient frontier is that we borrow at risk-free return. Okay. So when we borrow at risk-free return, this is 7. So what I am doing is that I have put 1.2 money in my risky assets. This 1.2, 1 is my own fund and 0.2 is the borrowed fund. Okay. So if I get 15 rupees, from this I have to minus the cost of borrowings. So what is my cost of borrowings? 0.2 into 7. So that's what I am saying here, that this is my total returns I have got and this is the amount that I am paying for cost of capital, means how much money I have borrowed. So 0.2 I have borrowed, I will multiply with the rate of return at risk-free rate. Okay. So whatever I get is the return of a levered portfolio. Friends, let's compute and see what's the answer. So I have calculated and you can see that the levered portfolio gives you 16.6. Remember in the earlier case when we had a risk-free and efficient risky assets, we had 11.8. But here you are getting this 11.8 was less than the market return 15. But now you are getting 16.6 which is greater than the market return 15. So that's why it is called levered, because when I have borrowings in my portfolio, it will give me higher return, higher than the market return 11.8. Okay. Also you see I have written here standard deviation of the levered portfolio in the risk. So W into standard deviation of the market. W is 1.2 and standard deviation of the market, as I have assumed earlier, also 8. So it comes to 9.6. So if you remember, earlier it was 4.8, which is less than 9.6. So when you have borrowings in your portfolio, you will find that your returns are increasing and your risk is also increasing. So levered portfolio leads to increased return with increased risk. So this is for those who are risk takers, whereas this part represents risk averser. Why? because they are making combination of risk-free assets and the risky assets. This represents the combination of risk-free assets and risky assets. This represents combination of risky assets and borrowings. So this way the line is linear and straight. So friends, the idea is that in this video we have learned that efficient frontier, if we have some efficient portfolio that represents the risky assets, with this risky portfolio, risky asset, I can combine the risk-free assets with risky asset, I combine risk-free asset, and that helps me to reduce the risk, and of course we will earn lower return than the only risky assets or the market return. This strategy is useful for those investors who would like to take less risk by diversification, whereas if you are a risk taker, you can go for a levered portfolio where you go for borrowing, and through borrowing you are able to increase the returns, but of course it will go at a higher cost, that is more risk. So friends, that's all. We have also seen the capital market line equation. So capital market line, that straight line from here to here is known as the capital market line, and this capital market line is nothing. It tells you that every investor will earn something which he gets from the market as a risk-free return, but since he has taken risk, he will get some reward also. That means he should get minimum this 7 rupees, plus he should get something more because he has taken some risk. Okay, he has taken some risk. So what is the risk he has taken? He has taken this much amount of risk. Then how much premium he should get? He should get the ratio, in the ratio of the reward to risk ratio. What is the reward? I get say 0.2 as the reward. Out of how much? 1. That means my reward to risk ratio is 0.2:1. Okay, or you can just say 0.2. So this says that if I have taken more risk, I will get more amount, a bigger amount multiplied with 0.2. If I have taken less risk, a lesser amount will be multiplied with 0.2. So this is your capital market line, and this factor is also known as the reward to risk ratio, or it is also known as the Sharpe ratio. So friends, that's all for today. We have seen the part 2 of the efficient frontier. Part 1 was already discussed in the previous lecture. We have seen the capital market line, and in the next video we will see security market line. Till then, keep watching my videos. Do like, share and subscribe my channel. Thank you. Take care.